Ryan, how about introducing yourself?
Is it this, Ryan?
Yep, that one.
Hey, I'm Ryan Nash. I'm the COO at Gust, joined by Pete here, who's our CEO. So we're going to give you, I'm going to call it a fun presentation about the nitty-gritty stuff of preparing for a professional round. Pete and I have been working at Gust for almost 8 or 9 years, so we're kind of entrepreneur adjacent, both with a technical background. I kind of veered into people ops and operations in the last 5 or 6 years, but we love startups. We love Seattle Angel Conference. Elizabeth, it's awesome to actually see and meet you. I haven't helped you out over the last week or so. And I'm excited to, honestly, the intros part of this is one of the cooler things about Seattle Angel Conference. I first thought it was sort of strange that we'd spend so much time getting to know people, but it's one of the coolest things. So it's awesome to hear all the people. I'm in New Jersey, so I'm not a Seattle person. Sorry, I'm a trader on the other coast. But looking forward to today's discussion.
Cool, thank you. And Peter, how about if you introduce yourself too?
Yeah, sure. I think Ryan gave me a decent intro there. There's a lot of overlap. I'm currently the CEO at Gust. We build products that are intended to help entrepreneurs and investors kind of navigate the early stage fundraising ecosystem. Again, have an individual contribution and technical background, and have been spending the past 8 or 9 years now working on entrepreneur products and legal tech products and fundraising products, and really have absorbed quite a bit of knowledge. And what we often find is that folks coming up to their first kind of outside round don't have access to a lot of resources, have a lot of confusion. So hopefully today we can clear some of that up and provide some education.
Yeah, that sounds good. John Dex, did you have a question that you wanted to put something up before we get started?
Oh, yeah, I think maybe you mentioned it, but I just wanted to point out to people that if you want to get connected to SAC 21, the program, or anybody else here, if you want to network, use chat. A lot of information is being put into there and will be during the conversation today. So keep your chat boxes open and participate as you can.
Yeah, that's great. And specifically, if you want to be found later by folks, put your LinkedIn into the chat and people will be able to connect with you if there's some magical synergy that will pop up for people. So Trevor, you're just in time. Is your audio working? There it is. If you want to introduce yourself, 15 seconds. Who are you, Trevor? And then we'll jump into the program.
Yeah, hi, I'm Trevor Petrie, and I'm a co-founder for Grace Enabled.
Cool, thanks so very much. And I'm John Seacrest. I run a bunch of programs to make the startup ecosystem go faster. The sort of kingpin of that is our Angel Conference, but we do open coffee every week. We do Lean Startup every month. I help startup weekends to help people find their co-founder, and we run a peer funding a fund manager peer learning group for people who are wanting to professionalize their angel investing. So building that whole art. And part of what we see is that a lot of times people just don't have the pieces in place to move quickly. And so that's one of the reasons that we're working on this particular talk, is I think we can get a lot of foundational stuff anchored early in the conversation and tighten things up. So Ryan and Peter, if you want to kick off, that'd be great.
Yeah, sure thing. Let me get my screen shared and we will get started. Okay. All right. So John, I think your terminology for describing what we're going to talk about today is actually better than ours. We have it titled Your First Professional-ish Round. I think John described it as your first outside round. I think that's likely a better descriptor. What we're going to be talking about today is the things that you want to kind of have a general knowledge of when you are fundraising outside of your personal network for the first time. So this is maybe a pre-seed round, seed round, where you're actually talking to people who are investing as angels in a semi-professional fashion. As I said earlier, what we find here is that on both sides of the table, especially with more previous operator angels coming in, there's a lot of confusion about terminology. There's a lot of confusion about what kind of things you need to get in place. So what we're going to concentrate on today is trying to hit the high notes of the things that you should be aware of to give you a leg up in that concern from both sides of the table. And we always preface this with saying the most important thing for your company is to get the resources it needs to be successful. Right. So everything that we say today is going to help educate you and give you some information to help you move forward. But you may not be able to nail everything properly because you'll have different amounts of leverage and different needs. But we do think that kind of the second most important thing is that you have an understanding of this stuff so you can understand how different choices might impact your eventual financial gain, your control of the company, et cetera. And the last thing I'll note before we get into this is that I am not a lawyer. Ryan is not a lawyer. So we can give you a good amount of information that we've absorbed, and we can tell you about how the industry generally works, but we can't give you direct legal advice, and none of this should be taken as direct legal advice. So with that, I will get started. So the first thing that we're going to talk about is company structure and basic diligence. Typically at this point, companies haven't really accumulated all that much stuff. So diligence isn't super deep, but there are some basic things that you need to have in place to, as John said, make the process go smoothly and kind of avoid a lot of costly corporate cleanup work. And really what we're looking to do here is avoid speed bumps and corporate cleanup costs. So the first is incorporation. And today we are going to focus on companies that are going to be raising from angels and VCs in the US, which means we'll be focusing on Delaware C Corps. Delaware C Corps are still the choice entity for most professional investors. Many states in the US have similar corporate codes, but Delaware has a tremendously built up body of precedent around those corporate codes. So investors and people involved in your business can have confidence not only in the law as written, but in the law as it will actually be applied, which is hugely important. If you are an LLC and you are looking to raise your first outside round, now is a good time to start considering whether or not it's a good time to convert. If you are looking into that conversion, there are a few different paths, one of which, if you haven't accumulated too much into the LLC, is to just dissolve it. The other is, as we've touched upon previously, to keep the LLC around for other R&D efforts and just transfer the IP specific to this idea into the new corporation. And in many states, there are some relatively simple ways to do a conversion of your LLC into a C Corp. That's typically called statutory conversion or statutory merger. If those things are available to you, that is another option. That's a talk in and of itself. If you're in that situation, interested in learning more, you can come find us and we can point you in the right direction. Once you create that business, and again, we'll be focusing on Delaware C Corps here, you're going to obtain a federal tax ID. That's your EIN. Once you have that, that's going to allow you to open up a bank account associated with the business. And that is going to be a necessity to actually take in the funds from your investors. Nobody actually is going to write you a personal check to invest in your startup. You're going to need to actually put that money into a corporate bank account. And then this is also important to separate your personal finances from the company's finances.
Hey, Pete, we got a good question in the chat.
Yeah.
Recommendations for a good bank. Oh, Igor already said Brex. We love Brex, but we have a couple others too.
Yep. So we love Brex. Mercury is also great. Ramp is wonderful. They all have slightly different things that can help you depending on what types of things you need. Brex is moving into a more holistic financial support realm. So they're moving into venture debt. They are helping consolidate stuff for bookkeeping and accounting. They'll probably be offering more financial products. Mercury is looking at things from a more holistic fundraising perspective. So they're doing community-driven things and trying to build up your network for actually finding investment. I believe that they will also be moving into future financial products. And Ramp is really interesting because they are taking a more holistic financial services-based approach, but they are also doing interesting things like doing collective bargaining for service contracts for their startups, which is super interesting. So depending on your personal needs, if you have a great fundraising network, then maybe you want to try Ramp or Brex to get some more like financial leverage. If you don't have a great fundraising network, Mercury might be a great option for you. But typically those neobanks are really nice. They allow you to have digital cards, single-use cards, limited cards, and they allow you to consolidate all your spend, which makes bookkeeping and accounting later on much, much easier.
There's another thing I'll highlight specifically about Brex. I'm not sure if Mercury or Ramp has it or has it yet. But Brex has a pretty cool feature where they will distribute your balance across multiple partner bank accounts and an optional money market yield account. Because if you're a startup and you raise a couple $1,000,000 or even a couple $100,000, FDIC insurance only covers up to 250. So it's nice to be diversified across banks. And if you're sitting with a big balance that's runway for 18 months to 24 months, why not have it in something a little bit higher than just a checking account? And Alborz said it's interesting that retail banks are not their first choice. It is seemingly like the neobanks are becoming more of a choice for startups. One, because Brex doesn't take your personal credit into account. They have daily underwriting using machine learning and artificial intelligence. I don't know exactly what that means necessarily, but it means that your credit line and your business credit builds independent of yourself, and you don't have to actually use your own personal credit to establish a credit limit. Brex in particular gives you basically the equivalent of a daily settled debit card when you start out. That's based on just the balance in the account that you have, but that eventually morphs into a charge card, like an American Express 30-day card. You build a business line of credit with them through their underwriting, and it's pretty cool.
Yeah, and I guess one thing to add too is that you don't just end up having one bank account as a startup. You may have a starter bank account and then a bank account for transactions or outflow. And obviously Silicon Valley Bank is still a huge player in the industry. If you get to a point where you need high touch banking relationship or access to other financial services that they offer a whole suite, then they can be a really great option as well. But starting with a neobank that you can get set up in 1 to 2 days does not mean you're prohibited from going and opening up an account with Silicon Valley Bank later down the line. All right, getting back to it. Incorporation and forming your company is not actually a transactional process. Incorporation is not the last piece. Once you file with the state of Delaware, you do have some other things to do before your company is fully formed. And until your company is fully formed, you haven't fully established the corporate veil, which means you are not personally protected in cases where suit is brought against the company. Your personal assets may be at risk. So you want to make sure that you get this stuff formed. Setting up these layers of governance is what is going to allow the company to operate as an entity on its own. And that is the foundation you're going to need to actually sign further legal agreements that can avoid future scrutiny. So the first things that you'll do here are adopting bylaws. Bylaws sit on top of the Delaware Corporate Code and add some specific information about how your company is going to be structured and run. You'll establish a board of directors. Your board of directors sits above the officers of the company and makes decisions on kind of a month-by-month basis. They sign off on a bunch of things. You'll appoint those officers. And typically the founder of a company, if there are no co-founders, will often sit in the officer seats. President and secretary are necessary for Delaware. Often you'll see president, secretary, and treasurer. So a founder may occupy all of those seats and also be the sole member of the board, but you still have to have all of those positions established to actually fully form the company. And the last thing that you need is to have at least one shareholder. Shareholders sit at the very top of the governance stack. They are involved in kind of a yearly cadence, and in the most important decisions, they will sign off on different things like appointing people to the board and any fundraising events and things like that. A little bit more about stock issuance to founders and early team members. We see people run into some similar problems as they go through this. One of the biggest ones is that promising shares is not actually the same as issuing them. So often we'll run into founders who say, yeah, I gave equity out in my company. And what they're talking about is an email exchange they had with the founder that said, oh yeah, we're going to split it 50-50. Well, that does have some legal standing. That equity hasn't actually been issued until you draft paperwork and get board sign off that an equity grant has actually happened. Now, this is super important because at the beginning of your company, the share price is established very, very low, usually a fraction of a cent. If you use our legal services platform, you'll end up with 4 zeros and a 1, which means that when you grant those initial shares, we typically have the founders pay for them in cash. Those grants are very, very low in cost. So you're buying in at a very low price, and any increase in the share price after that comes back to you as financial benefit eventually. If you wait to issue those shares, the share price of your company will be going up. So as you actually make progress in your company, it becomes harder and harder to say that it's still worth next to nothing. So if you hold off on actually making these equity grants, not only have you not fully formed your company, but the person who is the recipient of the grant is likely giving up some financial upside or accumulating some additional tax burden. The next thing that's really important is you should have a conversation with the people you're granting early equity to about the roles and responsibilities, what they're bringing to the table in terms of capital contribution and time. It's really important to be intentional about how you're splitting equity early on, because it is one of the most common things that comes back as conflict later, where people don't fulfill the expectations because the expectations weren't really clearly laid out. And once you have actually issued shares to people, it becomes much more difficult to shift around those percentages. So you really want to think about your co-founder equity split, especially before you make those grants, because recouping equity in cases where somebody isn't just leaving the company does have some significant tax consequences and can be complicated from a legal standpoint. You also want to leave a bit of wiggle room typically. We usually authorize 10 million shares for each company, and we suggest that the founding team issue 6 to 8 million of those shares to themselves, leaving 20%, 2 million to 4 million available for contractors, advisors, early team members, a future option pool. If you don't leave yourself a little wiggle room, you will have to go back to the state to authorize more shares. Each time you do that, there is cost to actually refile and amend your certificate of incorporation. And then there's cost associated with looking at all the grants that have been made, granting any refresher grants that you'll need to keep the percentages properly allocated and things like that. So leaving a little bit of wiggle room can be really beneficial. You can always fix things, but we try to keep them simple.
John's got some good questions in the chat, specifically about founder cash. So he's asking, should all founders contribute cash as well as time in the beginning? And can they add cash later on as the company needs more cash?
Yeah, absolutely. And this is another common misconception we see. Often people come to the table and they say, oh, I want to put 10K into my company, and I'm going to do that in exchange for my shares. We typically advocate that when you are buying your founder shares, you do not buy them with a large amount of cash, because doing that will set a share price, a fair market value of the shares in the company. So we say pay par value for the shares, and then if you are going to contribute money to the company as a founder, look into different ways of papering that. One common one for kind of rolling monthly amounts would be a grid note or a rolling loan, where you make a low interest loan to the company that you can add to over time. If you are going to put a lump sum, if you and your founders are going to put a large lump sum into the company that could be considered a pre-seed round, then you can look into options like treating yourselves as investors and investing in a similar instrument to what an early stage investor would use. And we'll go into that a little bit more in depth down the line. And then it is not necessary for every co-founder to put in an equal amount of cash, skills, sweat, etc. It's really up to you and the founding team, as long as you are precise and explicit about what everybody is putting in, and you are using those inputs to come to what everybody feels is a fair equity split. What's most important is that the founding team understands and feels good about what everybody is putting in and how that is translating to the amount of equity they have in the company. And that's important from a founder perspective. It will also be important when you start having conversations with investors, because they want to understand that the equity in the company is attached to a resource that is building value in the company, which is actually a great segue. Vesting is a must for everyone. we see founders, especially solo founders, come in all the time and say like, oh yeah, everybody else will have vesting on my grant, on their equity grants, but I'm not going to because I founded it. You can do that, but the large likelihood is that when you approach investors for your first round, they will ask you to modify that vesting schedule to a more traditional 4-year vesting schedule with the 1-year cliff. So we suggest that everybody has vesting on their grants. It communicates to investors that you are involved and dedicated to this company for the long haul. Anybody putting money into the company wants to understand that the team that is responsible for mobilizing that money and creating value is invested in the company over the period of time that money is going to be put to use.
Can you go into just a little more pedantic definition of what vesting means and what you mean by the normal 4-year cliff?
Yep, absolutely.
Code words.
So for founders, typically you'll be getting restricted common stock. So you will be getting direct shares of the company that will allow you to vote as a shareholder. And those shares of common stock will typically vest in what's called reverse vesting. So you as the grantee will get to vote and get all of the rights associated with those shares immediately. But the company will retain the right to repurchase any unvested shares if your service provider relationship with the company ends. So what the IRS does is they look at that and say, oh, okay, you have a substantial risk of forfeiture for all of these shares that the company can automatically repurchase if you leave. So the IRS actually looks at each vesting post as an income event. So typically what you'll see is a 4-year vesting period, which basically says like to get all of your equity in the company, you have to remain with the company for 4 years. You will often see a 1-year cliff, which means nothing will vest until a year has passed. And then if you're on like a 4-year vesting cliff, 25% will immediately vest at the year mark. And then you will have vesting each month after that until you accumulate all of the equity. That 1-year cliff is really important because so much changes in that first year. That is where it is most likely that you will have significant issues with co-founders or really find that expectations aren't being met. And that 1-year cliff gives you a whole lot of latitude in terms of figuring all that stuff out and not risking a huge chunk of equity. And I touched on this a little bit.
Vitaly is asking, do non-US residents have to send in an 83B?
Good question. So real quick, just to set the stage for that, as I said, the IRS looks at reverse vesting and says that there is a substantial risk of forfeiture. So the IRS by default will assess or recognize an income tax event at each vesting event over the course of 4 years. If you are a startup founder building a high growth company, the assumption is and the hope is that in year 4, your share price is going to be worth significantly more than a fraction of a cent. And if you are now paying income tax on the delta between that original purchase price and the purchase price in year 4, that can be a relatively large income tax recognition on an illiquid asset. All right, so you're not getting any cash out of that, but you're having to pay cash to the IRS because of the appreciation. So what the 83B election allows you to do is say that I want to pay income tax on the entirety of this grant in the year that it was granted. And typically for founders who are paying cash for those initial grants, the income tax burden is effectively reduced to 0. So the answer to the international question is it's a little bit of a gray area. 83B only applies to people who are paying US income taxes. However, if you are residing internationally now, but you have some indication or thought that you will become a US income taxpayer over the lifetime of the vesting of the grant, it is good to just go ahead and file the 83B election anyway as a cautionary measure. So if you do become a taxpayer, then you don't have to sweat it because the 83B does have to be filed within 30 days of the grant date. Nothing to do with whether you're a taxpayer at that point or not. So the safest thing to do as a foreign founder who has any prospect of becoming a US income taxpayer is to just go ahead and file it.
So
Yeah,
I'm very confused at the moment. If I'm not a US tax resident, I don't have a social security number. What number do I put in on when I file the form?
So when you file 83B, you just put in foreign.
Yeah, the tax ID field. We basically advise an abundance of caution with this just because the upside is so significant. We literally on the platform print out like a worksheet. We advise you to send a self-addressed stamped envelope via certified mail to the IRS so that they have to send you back a confirmation that's like, yes, we received your letter, so that in some other future when you're filing your taxes, you have the proof of it.
All right, anything I missed on that, Nash?
I don't think so. I'm just looking at John, did you have any additional questions? I'm not sure if the explicit thing was a comment or a question.
Well, I wanted to make sure that when you say explicit, that you meant writing it down so that all of those co-founder agreements actually turn into pieces of paper, not just handshakes, and being clear in verbal is not the same as being clear on a piece of paper.
Yes.
Yeah,
Um,
absolutely. And what
But
you'll
I
see.
also, go ahead.
Oh, no, go ahead, John.
I was going to change subject, so go ahead.
You'll see a lot of founder agreements out there that will specify a whole bunch of this, including founder roles and responsibilities. A lot of those pre-formation founder agreements are meant to have a lot of those clauses transform into actual legal reality during the incorporation, formation, and equity issuance process. What you don't always get during that process is the roles and responsibilities explicitly spelled out between your co-founders. So that is a good thing to do offline on a piece of paper anyway, in addition to all of the other company formation stuff.
And I would say also just be sure you have explicit stock grants, because I see a lot of times people go and they get incorporated from some service and it's like there's a promise in the post-incorporation documents that the CEO is going to get 70% and a co-founder is going to get 30%, but they're almost always delineated by like to be clarified in an actual stock grant with actual shareholder agreements and actual documentation. So those aren't good enough. If you go and get incorporated, do an action by the incorporated, appoint yourself a director and promise some shares, like that doesn't mean you have the ownership. You want the real grant documentation to be fully executed, signed.
Yeah. That is a great clarification. Often the first action by the board will preemptively authorize grants and provide board approval, but that is not all you need. You need an actual stock grant notice, stock purchase agreements. You need all of those to be separately signed in addition to consent by the board.
Cool. Ayun has a question about the valuation of what capital gains means with an 83B.
Sure, it's a little bit tough. We should probably have an example here. But if we imagine just a simple case of a founder getting shares on a 4-year vesting schedule with a 1-year cliff, the IRS, even though you get all of those shares, you pay cash for them, and you are granted them today, the IRS looks at that vesting schedule and they don't start recognizing income tax events. So they don't recognize the shares being substantially yours until that first year elapses. So when you buy the shares, they're worth 4 zeros and a 1. And if 1 year in, they're now worth 3 zeros and a 1, the IRS is going to say, okay, you now have had an income tax, a taxable gain of those shares, what they are worth now and what they were worth when you originally paid for them. And as the share price continues to go up, at each vesting event, the IRS will recognize taxable income. So what the 83B basically does is say, IRS, please ignore the vesting schedule. I am going to recognize all of this as taxable income now. And because you are doing that in conjunction with the initial purchase, typically the actual taxable income is 0.
I think it's worth noting it's not capital gains. It's actually income tax considerations that the 83P aligns to. Capital gains comes later if you actually sell those shares in like an IPO or an M&A or possibly a private market transaction as the world continues to move towards private market liquidity. But the 83B is around income tax. There is some stuff we'll probably want to talk about in terms of capital gains and qualified small business stock, but I think that's further in the slide deck, right, Pete?
We can touch upon it here because it does resonate with the be intentional about your equity split. Typically, when shares are issued in a Delaware corporation, they qualify for what's called as qualified small business shares or qualified small business stock. Qualified small business stock, if it is held by the original holder and it is held for more than 5 years, that qualification allows you to write off up to $10 million in capital gains. So that can be a huge windfall for both founders and early angel investors, but there are qualifications related to that. So if, for example, you need to reshuffle your founder shares, and the way you do that is transferring some of your shares to a new co-founder, the new co-founder receiving those shares is now receiving shares that no longer qualify under QSBS. So they are now losing out on potentially huge capital gains. If instead the company starts repurchasing shares from people who are not leaving the company, so the repurchases are happening in conjunction or not in conjunction with a departure, then those start qualifying as redemptions. And if you hit a redemption limit, then you can blow QSBS for the entire company, which can be a huge issue for early investors. So that's why it's really important to try to be intentional about these things and to protect the equity with vesting.
Peter, excuse me, when you say 1 year cliff, do you mean a 1 year exclusion?
What do you mean by exclusion?
On the vesting schedule, do you give away the shares after a year, the 1 year cliff?
Yes, so the 1 year cliff essentially says, well, I guess to go back to an example, if I grant Ryan 5 million shares today, and it is shares of restricted common stock subject to reverse vesting, and I apply a 4-year vesting schedule with a 1 year cliff, then as of today, the grant date, Ryan can vote all of those shares and he owns them from a company governance perspective. However, the company retains the right to repurchase all unvested shares if Ryan leaves the company. So if Ryan leaves the company between today and January 6th, 2023, the company can automatically, with no additional consent from Ryan, repurchase all of the shares associated with that grant. So even though Ryan had all the voting rights associated with them until his departure, the company can now recoup all of them and not have to worry about QSBS. They recoup them for the initial purchase price, and somebody who is no longer contributing to the company does not hold a whole bunch of equity. Now, as soon as Ryan's tenure hits day 366, 25% of that grant now vests automatically after that year. So if Ryan leaves the company on day 366, the company can now automatically repurchase the unvested shares, which are 75% of that grant. But Ryan has the right to retain all of the vested shares, which at that point would amount to 25%. And after that first year, after the cliff is over, then vesting will typically remove the right to repurchase from shares on a month-over-month basis, evenly distributed until the full vesting cycle has completed. So the cliff is just an amount of time where nothing is changing.
So
Thank you, Peter.
we have Albor's asking the question of, when you said spousal consent, what is it exactly that the spouse is consenting to?
Great question. So essentially the spouse is assigning power of attorney in concern to the grant itself to the spouse that is getting granted the shares. So they are saying that I am allowing the spouse to vote the shares, to make the decisions associated with the shares. And they're also opting in to be bound by the agreements associated with that grant, like the stock purchase agreement. And that's typically because in any community property state where an event would transfer ownership of those shares to a spouse, everybody associated with the company wants there to be no question as to whether the spouse is bound by all of the restrictions that were associated with the shares initially.
Yeah, it's avoiding the weird edge case downside where a divorce happens, somebody else owns the shares, claims that they don't have to be bound by the shareholder agreement because they never agreed to it, and thus messing up all the restrictions that are placed on common stock to protect the company and taxes and gains and all those things. Stuff a company just doesn't want to have to deal with, 4 years in when things are going well.
Yeah, and a lot of this is to avoid questions, future scrutiny, and chasing signatures.
Cool.
All right, next up is intellectual property. As you are probably all aware, most startups these days outside of physical goods accumulate value through intangible property like intellectual property. At this point, you may even be pre-product or pre-something in the market, pre-customers, but you may still have accumulated value based on the progress you've made. And one of the key things that investors are going to look for in your company is that it owns all of those intangible assets that are giving it value. So the first thing you'll want to do is make sure that in conjunction with their founder stock grants, that founders are signing intellectual property assignment agreements. This essentially will assign all of the work that the company or that the founder has done on behalf of the company prior to its existence. It will transfer all of that into the company and will make sure that any future work they do for the company is also covered. Typically, these also have non-disclosure and non-compete provisions in them, and they act as kind of a very light employment agreement that is not actually an employment agreement for co-founders. You'll also want to do the same for contractors. This is especially important in the US, where the default is for people contracting for your company that they own the IP, but your company maintains a perpetual license to it. So you will want to make sure that your contractors are under contract in a way that assigns all the IP that they are generating to the company explicitly. Advisors and contractors, same, and typically those agreements will also include non-disclosure and non-compete provisions. And then if you're outside of deep tech, you can look into things like provisional patents or public disclosures to kind of protect your ideas and prove prior art. Typically at this level, unless you're doing something that is very technical, that really qualifies as an interesting and novel invention, it is typically too early to think about actual utility patents, and the expense may not be worth it. If there's any question about that, certainly it is worth talking to an IP specialist if you think IP is really going to be a backbone of your startup's value. But typically you can get a long way with looking at provisionals or public disclosures. All right, into fundraising terms.
Dragon has a question. If there's a pre-existing company using the same IP, would it be possible or okay to just assign the usage rights to the IP to the new company?
You certainly can. There are a bunch of ways that you can allow other people and entities to use existing IP. Just keep in mind that when you are presenting to investors, they are going to have some questions. If that IP is really core and valuable, and it's going to accumulate value into the company, they may have some concerns that the company itself doesn't own it and that it's owned by a different entity. So you won't be able to use that IP as a value marker and a value builder in the business that has a license to it. That would be a value builder in the business that effectively owns it or has like the master license to it.
It's probably worth pointing out. Oh, go ahead, John.
Go ahead.
Oh, it's worth pointing out, because I think this is an area of confusion often, that patents are awarded to individuals. They're not awarded to companies. They are licensed to companies. So even if you pursue a patent while working at a company, usually your employment agreement says like any patents that you file will be owned by the company or perpetually licensed to the company forever and ever and ever. But you'll often see the patent literally has individuals' names on it. So that's a thing that I see companies misunderstand a lot. Like, oh, my company needs to get a patent. It's like an individual needs to get a patent, but that they can license it to a company.
Yep. So there may be questions about that in particular. You'll want to be explicit and careful about which company is allowed to essentially resell that patent on behalf of the patent holder. It's essentially who holds the rights to monetize that patent or otherwise utilize it that will be able to build value in the company based on it.
We have a
Ayun
question
asks-
from, oh, you're gonna grab that, John?
Yeah, go ahead.
Ayun asks, this is a great question about all this stuff we're talking about, is how enforceable are these agreements? His thinking is small companies don't have the funding to litigate, so why bother?
Yep. So again, good question. And as you pointed out, like the US-based legal system is based on litigation. Anybody can sue anybody. And in a lot of cases, the person with the most money can win. But it is still easy enough to do all of this stuff that it is worth doing to allow you the leverage, basically A, to avoid getting into litigation wherever possible, and B, to utilize it in litigation if you have to. So if you get to a point where something comes up and there's any question about it and it's not in writing, then all of this becomes much, much harder and more expensive to prove, to enforce, and to litigate. And it is relatively inexpensive to get it in paper and get it signed. And that will give you tremendous leverage in defending against or bringing suit if you need to. The system certainly is not perfect. There are issues with enforcing much of this, but without having these things signed and documented in an explicit way, as John said, writing something down and signing it is very different than exchanging emails with somebody. The value of that from a legal perspective is much, much higher. So doing this stuff just gives you a lot of safety and leverage and reduces a lot of time and cost if the bad things happen. All right, fundraising terms. Goals here, trying to avoid surprise dilution and give you enough information to keep your options open. A lot of times what we see, especially in early rounds, is that people don't quite understand how the instruments work. And then they mix and match and they get to a later round and they're like, oh, I sold way more of my company than I was intending to. So typically, early rounds are often executed via what are called convertible instruments. These come in a couple of flavors. The SAFE and the convertible note are the most common. The SAFE is simple agreement for future equity. YC brought this out, I think, 6 years ago now? Convertible notes have been around for a little while longer. Both are promises of shares in the future. So when you execute one of these agreements, it does not immediately impact your cap table from a common stock perspective, but they are intended to convert to shares in a future priced round. Typically, that would be a Series A. Although, if you do a convertible pre-seed and then a priced seed, they could potentially convert at that point as well. Major difference is that convertible notes are debt. So they do have a maturity date. They do accumulate interest, while SAFEs are not. What that means in practice, because investors are not looking at these things as debts that they're going to recoup with some interest. They're looking at them as long-term bets. What that means is that the maturity date on a convertible note gives the investors you're working with a little bit more assurance and a little bit more leverage to have a conversation when that maturity date hits. Often what happens and what is written into these agreements is that the convertible note maturity date can be extended by majority signature of the note holders, and that will typically be what's going to happen if a priced round hasn't happened prior to the maturity date. And these are designed to effectively reward early investors for their risk. And the way that is done is either through a discount or a valuation cap. So typically you will see one or both of these. In the earliest rounds, you'll often see a discount, which basically says that the investors will put in an amount of money now that will give them the right to buy shares in a future price round at, say, a 20% discount. So that means if your future institutional investors come along and they negotiate with you a share price of $1, then all of your investors with a 20% discount will get to put all the money they invested towards buying shares at 80 cents on the dollar. A valuation cap provides similar upside protection, but the way it's structured is that it puts effectively a cap on the pre-money valuation of your priced round. So if you have a valuation cap of, say, $5 million, and at your priced round, you negotiate a pre-money valuation of $7 million with your investors, then your early investors will get to buy shares as if the pre-money valuation of your company was 5 million rather than 7. We'll get into this a little bit more in depth because it's confusing, but those are the basics. And really what they're designed to do is have companies and investors avoid a lot of the back and forth and a lot of negotiation around a priced round, avoid the negotiation around setting an explicit valuation and setting an explicit share price, kick that down the road and get money into the company quickly. And all of that can be really good for both sides of the table because it avoids unnecessarily cost and friction, but it's important for both sides of the table to understand what they're actually buying and giving up as well.
So I wanna dive down a rabbit hole for a second on this.
Yeah.
I will be pedantic and say that a startup is an organization that is searching for product market fit. And a business is something that has product market fit. So when we're talking about startups and startup valuations, then all of the mechanisms for doing a startup valuation are designed for post product market fit. I have revenue, I have customers, I have some kind of margin. I look at my EBITDA, I look at my growth rate and do the little magic thing in the equation and poof, I get a valuation. But that's after product market fit. And when we're doing pre-seed and probably seed and definitely probably Series A, we're probably barely at product market fit. And so none of those equations work. And so we have to pick some kind of evaluation out of this mix, right? And so when people are doing convertible notes and they're arguing about the valuation or the cap, depending on how we're thinking about that, the startups often aim for, well, bigger valuation is better because bigger valuation means I'm selling less of my company. And so I want to talk a little bit about that transition from I do a 12 million valuation for 2 guys, a dog, and an idea, and then I get the product market fit. And what are the consequences of that 12 million valuation instead of the 3 million they probably should have had?
Yeah, we can get
Here we
into
go.
that
Look at that.
a little bit here. So I think the main consequences of getting this stuff wrong is that once the information actually comes in and your company, your startup becomes a business, that the information you get ends up pointing to a lower valuation than you set, which sets up your startup for what's essentially a down round. And when you're doing that, you are putting yourself in a position of tremendous negative leverage in terms of your dilution, the progress of the company, external perspective on the company, momentum, all of the things point in the opposite direction of what you would like them to. So that is one reason why it can be very dangerous to actually do a priced round before all of that information is available, because that is going to set a very hard share price. That is something that you can't really, you can never pretend that didn't happen. And that will be the necessary basis kind of for the next round. Now with the valuation cap and discount, setting those is still important, but it is less potentially dangerous. So if you have
the difference between a valuation and a valuation cap?
Yep. So that's the big one. And our first point here, valuation cap is an investor protection. It's not a representation of the value of the company. what the investors are looking at when you're negotiating a valuation cap is, okay, how big do I expect this company to get when it hits the price round? And like, how big, because the markets are crazy and startups are crazy, like if this thing really takes off and it really exceeds what we expect it to hit at that price round, then your early investors can end up getting almost completely squished out of the cap table. So what they're doing is saying like, okay, if things go crazy good, way beyond our expectations, we're going to set a cap on the valuation so that we don't get squished out and so that we can maintain some percentage ownership of the company that will make our investment valuable to us from a return standpoint. So while it does have, it will point to somewhere around what your company might be valued at. The hope is that you exceed it, but exceed it not by too much, and that it's somewhere in the middle.
Yeah, I think a good example for that is, say you're a company and you're raising traditional seed angel checks of like $25,000. So an investor takes an early risk on you, gives you $25,000 and signs an uncapped convertible instrument, safe convertible note, whatever. They're like, hey, we're taking an early risk. We like you. We like the market you're going after. We trust the two guys, an idea and a dog, but like, we don't have enough information to figure out what this is possibly worth. So we're going to give you money now. We'll figure it out later. Then that company goes Instagram rocket ship style. The next time they raise funding, their valuation is $30 million. All of a sudden, that $25,000 can buy very little shares in a $30 million company. So these investors who took a really, early risk on you are left holding the bag, or the lack of a bag in some ways, and being like, oh, man, we really missed out. So what a valuation cap does is being like, in the event of that outsized success, say they put a $7 million or $5 million valuation cap on it, when they do the math to convert to how much shares they can purchase with that $25,000, they're going to do it as if the company was raising at a much lower valuation. So their buying power is going to be much bigger than it would be if they had to participate in the later terms. And that's usually quite justified because they took the early risk. A discount operates similarly. It's a little bit more straightforward because you just say, hey, you get a 20% discount when we go and raise the round. So if new investors are buying it at $1 a share, you can buy it for 80 cents a share. Therefore, your $25,000 actually acts more like 36 or 38 or something like that.
Yep.
And to be clear, you typically either do the discount or you do the valuation cap. You don't get to do both at the same time.
You can, and effectively what will happen is if the valuation is not above the cap, the discount will hold, and if the valuation is above the cap, the cap will kick in. But it is far more common in the climate today to have one or the other.
Yeah, it's worth noting, to be explicit, up until today, most instruments have both a discount and a cap, but only one takes preference, and it's almost always the one that gives the investor the better deal. It's usually in the documents itself. That's like the greater of, or the cheaper the share price. So you'll be signing usually instruments that have both a cap and a discount. They often converge to be the same as the valuation starts rising. Just in the last year, interestingly enough, the YC Post Money Safe, which is another convertible instrument, they removed the option to have a discount and a cap at the same time, and they only publish a discount safe or a cap safe. I don't really think they put much justification as to why they made that change, but that's just an interesting wrinkle in the last couple months.
And we'll talk a little bit more about this, but it's also important to understand startup trajectories generally and YC startup trajectories. YC is building for a very specific type of company, and the documents and kind of the guardrails that they're putting together are a really good fit for the companies that they are shepherding through their programs to their downstream and follow-on investors. They have made a business of identifying companies that act and grow like companies that can get investment through these types of instruments and not have downside consequences. And it is important to understand how that relates to your company and your access to investment professionals and their relative sophistication, because it may not always line up one-to-one. And when it doesn't, there can be some consequences that we'll talk about. So it's in your best interest on both sides of the table to at least have a basic understanding of how these things work and what the expectations are if you fundraise through an instrument like these. So coming back to the valuation cap briefly before we move on to some of that stuff, it's still typically determined by company info, comparable raises, amount of money needed, and the amount of ownership an investor wants. So those are some of the things that are going to go in. You don't have some of the harder factors that are going to be looped into valuation later on, but you do have some of the other factors that will typically be used to value a pre-product, pre-revenue company. There's also an alternative way to look at this from the founder side. It's good to understand how much money you need and how much of your company you're willing to give up for that money. Because just like investors are doing the calculation on the other side of, I want to invest for this percentage of the company because that is what is going to make me return. You can do the same on the founder side, and that can be super helpful and a much more simplified way to look at it. I think it's worth breaking it down to the component parts, and then also worth looking at it from a amount of money you need and percentage of your company that you're willing to give up for it. That also forces you to look at things like, what am I going to put this money to use for? How exactly am I going to use it? Do I actually need it? Where is it going to allow me to get to in terms of milestones and growth? Those are all really important. You'll need to communicate those to your investors, and you can use that prior to even going out to convince yourself that you need to raise, that you can mobilize that money well, and to figure out what the terms should look like generally.
So Tom is asking, what's a reasonable seed round equity to give up based on a valuation cap? And I sort of want to take a step back even before that question about the 5-year, 7-year financial modeling and modeling the capital stack. Do you have any support or tools for that, and some notion about how much of the company you give up at each round?
We do, and it does certainly vary. We've seen anywhere between 10 and 20% of the company being sold at each successive round. That obviously changes based on the amount of traction and leverage that you've accumulated as a founder, and the market from an investor perspective. And I think it is a good thing to do, to try to understand at a high level what your trajectory is going to look like. So are you going to pursue like the growth, the exponential growth or bust VC train? Are you looking to grow the company more organically and steadily over time? Because if it's the latter, then you really do want to do some of that capital modeling, so you understand whether or not these instruments are appropriate. If it's the former and you think you can do it and pull it off, then these instruments tend to be a really good fit. But kind of understanding where your Series A lies in terms of time frame and in terms of the amount of capital you'll need to get there can be really, really helpful and help you avoid a whole lot of pitfalls.
Hey, Pete, I just pulled up the infographic that we published a bit ago. Do you want me to walk through that real quick since we have some time?
Yeah, absolutely.
All right, can I steal screen share?
I believe so.
I think you have to stop presenting before I can.
I see new share. Got it. Yes.
All right. Cool. So this might be slightly, can you guys see this? This might be slightly out of date in terms of dollars, because I think we put this together a couple years ago, but this kind of walks through your typical scale-oriented startup and some of the stages and what you can roughly expect to give away in valuations. Now, this is not going to fit all industries. Biotech is usually more capital intensive than something like enterprise SaaS, et cetera, but it's just a rough ballpark. So up top here, we kind of see sort of what John was talking about is really early days, this problem solution, team solution fit. You're not a business yet. You're trying to figure out, if there is a business there, you're a startup. Once a product market fit is achieved, now it starts to move into scale. And then down here in the similar stages, you see the kinds of investors you're thinking about talking to. So really early on, it's pretty much your own money, maybe people that you know. Please do not take investment from children. I don't know why we have a child there, but children should not be investing in startups. And then you move into angels, accelerators, up to the VC category, and then even private equity, SPACs, the whole world. SPACs were even a thing, I think, when we produced this. And then typical bell curves of, what kind of funding are we talking about? When it's just your own money, you're talking 10K maybe less, 5K, just, putting some money to get things off the ground. A friends and family round usually looks in the low tens of thousands, possibly up to 100, if it's a capital intensive business for whatever reason, or if you're well connected. And then you start to move up the train into the millions, the Series C's, the Series A's, and the big valuations. And this is actually more of...
Before we move on from there, it's probably worth noting, as John mentioned in the chat, and as we just touched upon, if you look at this infographic and then you look at the pre-seed and seed rounds that have come out of YC in the past year, or even out of Silicon Valley generally, you will see that the two do not match up. There is a very frothy investment ecosystem happening right now. And that may be available to you if you have previous exits, a really strong team, a really strong network, and you are running in those circles. But the reality for the rest of the ecosystems doesn't quite match up to that. So I think these are a little bit low, even for where the market has moved generally, but they're closer to reality than for many startups than the YC funding levels, trajectories, valuations.
Yeah, you'll definitely see a company raise their Series A and raise $12 million or $15 million now. I do think the level setting here, and we repeat this a lot, is the right amount of money to raise is generally the amount that you need. Raising more money than what you need or can deploy for use is actually not necessarily a great thing for your startup, because it generally means you're giving away more ownership of your company. You're setting expectations for future rounds. So if you raise again, if you raise $15 million and you only needed 5, if you have to raise again, that means you're going to have to raise at a much higher valuation, or you're going to do a down round, things get really messy, etc. So pretty much only raise what you need. And yeah, these bell curves probably all shift a little bit to the right. But this is specific to the question, how much are you giving up? This probably is a bit more timeless. In your friends and family round, in your convertibles, you're generally maintaining all ownership. But once you start to get professional investment, you'll start to see the founding team get eaten away by investors. You will always hear stories of super voting stock shares, brinksmanship arguing of like super high profile cases where the founder somehow still owns 60% of the company when they IPO. Those are ultra rare scenarios. Most founders should expect to give up a decent chunk of their company as they move towards Series B and A and stuff like that.
And why is that a good thing?
Generally, the more, there's smart money, which is money that also comes with advice, that comes with networks, that comes with connections and things like that. So companies need capital to operate. But if you have the privilege or the leverage to bring more people into your enterprise that have aligned incentives, it's often good for the company. It's good to have different perspective. It's good to have, resources, connections, a good board. Generally you'll find yourself expanding your board in this Series A, Series B thing, where you have people who can actually provide good advice, who have, felt the stings of business mistakes and seen things that you haven't had, to really ensure, long-term sustainability and success for the company, not just pump and dump or, failure to reach escape velocity.
So owning 10% of $1 billion company is better than owning 100% of $100,000 company.
Yeah, also that with the valuation here should be going up at the same time. So even if you have, a small percentage of your company, but it's worth hundreds of millions of dollars, that's much better than owning exactly what John said.
So the CEO task, which people don't manage, is you have to take the money and then grow the valuation of the company bigger than the money you put in. And when you do that, you keep getting bigger and bigger valuations, which is more and more value for less and less percentage of the company. And if you don't manage that relationship between value creation and number of shares allocated, then you hurt yourself as well as the other investors.
Yeah, absolutely.
We should talk a little bit about bottom up versus top down businesses, just so that people get some clarity about that. Do you use those words, Peter and Ryan?
We don't often, but I assume that we have some overlapping philosophy there.
If we have Facebook or Google kinds of companies, those are top-down companies where I have this, oh my God, total addressable market, And in the process, I take money and then I take more money and then I take more money. And eventually I get to the point where I have a business that's making billions a year. But everywhere along the way, I wasn't making any money. I was just living off of the investment. That's a top-down thing. I
Gotcha.
know where
Yep.
I'm going. I put lots of cash in and away I go. A bottom-up company, and these words come from Rob Wiltbank, who did some studies about startups and so forth. Bottom-up company is I'm making money. I'm profitable. I take some outside investment. I get bigger, more effective, more productive, and I'm profitable. And step by step, I go along the way where I'm an earner rather than a burner, right? And from an investor point of view, investing in earners gives you about a 14x value. You get much more money back on your money that you invested on average than when you invest in the burners that go very big, but there's so much money in the company that
Yeah.
you're just not getting as much back as you think you might.
And
Except for
also the
those
participation
very-
cost.
Yeah, and
Like a-
and there's a few people at the beginning that put in their 25,000 and now own $1 billion worth of stock, but that's a onesie twosie out of millions of cases. Anyway, you know, the startups need to understand which road they're on. They can't be on both roads at the same time.
Yeah, it's not to say one is better than the other, but one comes with much different expectations at pretty much every step. You know, kind of like looking through that thing is when if you're a top-down company, which is basically you're always raising money for some eventual, like, the system finally works. We have millions of people using our product. Therefore, when we flip on ad revenue, all of a sudden the revenue just comes pouring in, but it took us $700 million to get here. It's just a very different trajectory. You're talking with different kinds of investors. You're likely going to VC. The use of that capital is largely based on narrative, vision, salesmanship, you know, the finding like-minded investors who are willing to take big risks, and they're likely playing Moneyball with their portfolio. They're investing in a bunch of companies like you, expecting the vast majority of them to fail, but the one that actually succeeds is going to succeed on such an outsized success, 30, 60x what they put in. It will make up for the entire portfolio that basically falls apart. But there's a whole different investment realm of, like, if you're raising money because you have a good plan to deploy it to grow and level up your business, you can be talking to a very, very different class of investors. And setting your valuation is going to be different. The consideration is going to be different. Business fundamentals will probably matter a lot more. Forecasting matters a lot more, and things like that.
And that's part of the SAC question to the investors. What's your investment thesis? Are you a unicorn hunter, or are you an impact investor, or are you interested in companies that have a business plan that's functional, or do you care about revenue and margins? All of those things are different investment theses, and you can't apply all of those constraints to all companies and still get an investment out of it.
Yeah,
Yeah.
Pete and I
A couple
once.
of questions.
Oh, sure.
Go
You're gonna
ahead.
say something, Pete?
I was going to say, I think it's important to note that being a top-down company doesn't absolve you from traction.
Yeah.
Right. It's just traction
Different
that isn't
kinds.
necessarily communicated by, unit economics and revenue and business metrics. And you still have to have a story, a convincing story as to how that traction will eventually turn into revenue. Most times, especially as you get closer and closer to that Series B and Series C. So it doesn't absolve you from traction. You still have to hit metrics. You still have to grow, faster and better than the money you put in. It's just not communicated in dollars immediately.
Yeah, something John said, unicorns are $1 billion plus companies. Our original founder, David S. Rose, likes to call himself a gazelle hunter, which is you're not going after the unicorn for a 60x return, but if you hunt enough gazelles that give you 10 to 20, you can actually make a very compelling portfolio. And Pete and I have talked about the menagerie or the zoo of startups before. And someday, if I had enough time, I'd love to be like, well, this is a snail company, and this is a gazelle company, and this is a wolf pack company, but we're not there yet.
We should do that. I
Might be
see
fun.
Ayun is like overly anxious to get his question answered, but he has a question in the chat as well. Go ahead, Ayun.
Yeah, I just wanted to make a quick comment that sometimes it also depends on your exit plan. Sometimes there are adjacent business models that are earning, such as, you talk about Alexa as a business model, but it contributes to the overall ecosystem, or WhatsApp when Facebook bought it. It itself might not be bringing in money, but it's contributing to a bigger brand and adjacent businesses. And therefore, when you're a small company, the question then becomes,
you don't get to play those games when you're a small company. Adjacent means your partner right sitting next to you, and that's as far adjacent as you get.
Absolutely. But my question is going to be, is that a business strategy that you've seen with companies that might, where the end result is, I just want to be acquired by one of the big ones, and that's my exit strategy. And therefore, let's just build something that maybe isn't bringing in revenue to us, but it is valuable to those big companies.
Yeah,
Oh,
I
yeah.
mean, there's actually investment.
Sorry, let me jump on that. There's a guy named Basil Peters that wrote a book called Early Exit, which is all about that pathway. Designing a business product that gets acquired pre-revenue as the targeted goal, right? Let's exit in year 3 at a multiple because we sold something to a company that needed what we were doing, and we did all of the de-risking for them, and they just pay out cash. Then we don't have to spend all the money on customer acquisition that we're going to have to spend because they've already got it. Yeah.
Yeah, and there's actually angel groups that target that kind of business too. I think it used to be there was an Ohio Angel, wasn't a conference, led by a very charismatic guy with a bow tie, but his entire philosophy was like 5 years, $500,000, $5 million for the founders. And his entire thing was he'd take a company, build the company explicitly for acquisition by a leading player. So you would basically identify like, we're going to get acquired by Amazon. We're going to build something that Amazon doesn't have and totally needs, and we're just going to heads down. It's a big bet. If it doesn't work out, like you're usually left with not a lot of a business model underneath there. But that is, I don't know if there's a fun moniker for that kind of company, but it's definitely a playbook, I suppose.
Cool, let's go on.
All right, bring it back.
Actually,
back to
Aoun had a question earlier about boards. What do you look for in people you want on your board, and how do investors look at the board? And when you say board, do you mean board of directors or board of advisors?
Well, I guess that's an important thing to clarify just up front, is that they are different things. Your board of directors has explicit company governance function. They're signing off on things, sometimes a day-to-day, but more often a month-to-month. They have a fiduciary, or they have responsibilities to the company. They are a part of it. Advisors are service providers that are typically providing advice or opening doors in conjunction with a set of time-bound strategic objectives. But people do talk about advisory boards and boards of directors, and often they just say boards. So I guess a couple other things to clarify. Typically, your board of directors is only comprised of founding team members prior to a Series A. That's typically when investors will start negotiating for a board seat. Prior to that, it doesn't really make a ton of sense. If you do have somebody who is advising at a very high level that really just has extremely deep both operational experience and domain expertise, and they maybe have acted as an advisor prior, it's not uncommon to bring those people in as outside board members, board of directors members. That can absolutely happen, but those are definitely extraordinary individuals that are kind of in it for the long haul with the company. And yeah, as John noted, Founder Institute does have a great agreement called the FAST that can help you kind of determine whether or not somebody is an advisor and an advisory board member. If they fit any of the rubric in that, in the intro to that document, they're likely an advisor. If they extend beyond that, and you intend their role to be larger, but not to a co-founder or day-to-day service provider level, then maybe they escalate to a member or a director. And how do investors look at the board, I guess, is the follow-on to that. And I guess similarly to how they will look at everything else, they will want you to be able to communicate how each of the board members is contributing to the growth of the company. Keep in mind that, at Series A and beyond, investors will typically be getting board seats. So they will be sitting on the board with the people who are already on the board. And then once you have additional shareholders, those shareholders will be making decisions about who gets to stay on the board and who is added and when people get replaced. So you will definitely have to explain why somebody is on the board, what their function is. The investors coming on will likely want to understand how and if they can work with those people. They'll want confidence in that. And you should also understand that, as investors own more and more of your company, eventually they will have power to start dictating who sits on the board in addition to yourself and them. All right. How are we doing on time here?
We have 27 minutes left.
Okay, cool. Then I'll try to get through the rest of this in 10 or so. So last important thing about valuation caps on a convertible instrument is that they can be pre or post money, and that is dependent on the definition of company capitalization. Company capitalization typically includes all of the common stock that you've issued to founders and early team members, any common stock you've reserved under an option pool. And in the case of a post-money valuation cap for convertible instruments, it also includes all of the other convertible debt taken on in conjunction with fundraising. So what that means is, especially for the most recent version of the YC Safe, if you raise via a YC Safe, and then you end up needing more money than you thought you would before you get to that price round, then each of those additional YC Safes that extend beyond the amount you intended to raise are going to more significantly squish your ownership of the company. So essentially what the valuation cap is doing in a post-money scenario is saying that if you divide that the amount of money that the investor is putting in by that valuation cap, you are getting that percentage. And even if you take more money, then that the resulting percentage is not going to change. It will be additive. So obviously this stuff is complex, and there are a couple things that you can do to manage that complexity. The first is just to cultivate a basic understanding of how this stuff works. You can read the YC docs. They have relatively thorough examples. It's boring, it's lame, but it is worth doing if you are on this path, both from an investor standpoint and from a founder standpoint. We talked about this a little bit before, but a safe is not debt. It doesn't have a maturity date. If a company never raises a price round and you've invested via a safe, then there's not really a ton of recourse for you as an investor to recoup that investment. There's not a real definition of how you are intended to be repaid for it with anything more than you put in. You are now kind of relying on the goodwill of the company and negotiation in future rounds. So it's good to have an understanding of this stuff so you can apply it to your investment thesis and the type of companies you're going after. John mentioned this very early. We have seen some additional types of instruments that act like safes, but also have the option of converting into revenue share or profit share up to a certain cap to accommodate companies that are kind of optionally on an exponential growth path. To allow investors to recoup some return on the investment that is well specified if the company doesn't just go kind of VC or bust. Using different types of instruments and kind of mixing and matching can make things vastly more complicated and surprisingly unintuitive. If you take some money on a pre-money YC safe, the old version, and then you take some money on a post-money YC safe, but you use kind of similar terms, or you try to change the terms to naturally escalate in your favor as the company grows, you may not actually be doing what you think you're doing. And there are some really surprising ways that one can be more advantageous on both sides of the table. So as much as you can, try to kind of pick an instrument up through Series A or your first price round generally, and stick with it if you can. And either way, use some cap table software. It's tremendously helpful to be able to look at this stuff and model it out and look at how different things happen. As we said before, it's really a good idea to try to figure out, like, okay, when is my first price round going to be roughly from a time perspective, and how much money do I think I need to get there? If you have that information, you can start plugging stuff in to see what it looks like, to see how it will affect your dilution. And if you then use your cap table software, not just to plan, but to actually reify this stuff as you do it, you'll be able to kind of make it real, observe where you are, and plan the next steps, and not have to do a huge paper chase when the institutional investors come in. Option pool we'll go through relatively quickly. The big thing here is don't just take a broad, this is best practice option pool amount and carve out that much. You want to actually do the work of understanding what your hiring plan is going to look like when you raise money, and how much equity each of those people will command in the current hiring market. Once you know that, you can use that information to effectively advocate for an option pool that accommodates those people with a little bit of a buffer, instead of a potentially larger one that might be suggested by investors at a particular round because it is standard. The reason you want to do this is going back to that definition of company capitalization. Even if you haven't issued options from your option pool, if you've reserved a set of options under your option pool, those will be added to the company capitalization. They'll be added to the denominator. They'll be used in future calculations. So that could end up with additional dilution for you, the founding team, the existing shareholders through future rounds. As you issue options, and typically you'll do that when you actually start hiring W-2 employees. Usually that's coming with a relatively sizable round, and you'll be looking at hiring somewhere between 5 and 10. Your share price will be, beyond a price where it makes sense for somebody to buy in directly. The cash hit would be too much, or the income tax burden would be too much. So typically you'll start issuing options then, and that will allow somebody to get the option to buy shares in the future at a specific price without having to put in money now. Once you start doing that, the IRS wants you to get safe harbor from the IRS, they suggest that you get a valuation done by an external provider. That's called a 409A valuation. It will use a lot of the same metrics that we've talked about prior in terms of determining valuation cap and pre-revenue valuation. If you do have revenue, they'll use that. If you don't, they'll look at your team composition, they'll look at your traction, they'll look at public comparables with similar business models in similar markets, and they will come up with some justifiable common stock price. And you can then issue options at that price and have safe harbor from the IRS saying that is an unreasonable valuation and coming after you in the future.
But for the most part, valuation and 409A valuations are unrelated with each other, right?
Correct. Yep. 409A valuation is going to value your common stock. So that is going to be much closer to theoretically and justifiably what your company is worth today. Whereas a valuation in conjunction with a valuation cap or a price round is going to be an investor-facing valuation, either as a protection for their very early investment in the case of a valuation cap, or the valuation that they will be using to determine the share price that they're going to pay at a price round. So that is much more of a future-looking valuation. What will your company be worth in the future once you've put this money to use? Hopefully, as John noted before, to gain more value than the money itself is worth, and then some discount based on that because the investors are taking in some risk. And last but not least, securities compliance. Convertible instruments are securities, even though you're not selling shares directly. So it's important to remember that. If you're raising from accredited investors and you're not generally soliciting, meaning you are not talking to people who you don't have any idea whether or not they are accredited and telling them the specifics of your raise. So if you're not doing that and you know you're raising from accredited investors, you are in relatively safe territory. But it is also good to talk to a lawyer once you start raising. You will get a variety of advice about which exemptions to use and whether or not to file certain things very early on. But again, worth understanding, you are selling securities even in the early days. And it's lawyer time. They can help you. If you're going through a crowdfunding platform, they will help you. That is why they exist. And they will help you and introduce you to the people who will help you file all the exemptions you need to. If you're going to raise under Reg D, there are some technology platforms you can use, but still today, working directly with the law firm to manage filing your Form D and things like that is the typical way to go.
So you just said a bunch of magic words that a lot of people don't know what those magic words are. You said crowdfunding, Reg D, et cetera, right? So let's take a step back and nail this stuff down, right? So accredited investor is someone who's a millionaire, not counting your house, or has 200K in revenue or 300K with your spouse, defined in Regulation D. You should look up Reg D. That's better reading than the safe note. You should read Reg D for sure. All startups, all angels should read Reg D just so you know what the choices are, right? But you just said
absolutely.
You are in relatively safe territory, which is the classic lawyer answer, which is do a Reg D 506B, private solicitation of accredited investors. But you can do public solicitation of accredited investors with Reg D 506C, or you can do general public offerings through Reg A+, or you can do a Reg CF crowdfunding thing, right? And so WeFunder supports combinations of all of this stuff. Or you can give your contractors a Rule 701 option of giving them stock instead of paying them for painting the lobby. And all of those things are possible, right? So, and let me name Reg D 504, which is, sorry, feds, I don't really mean to talk to you. I want to talk to the state regulators. So I'm going to only do what the state regulators say, not what you guys at the Fed say with Reg D 504, right? And so a brief read through that set of things will help you understand the pathway so that when you, the company, selects to offer to sell a part of the company, you know what offering you're making. Right? Because it's not the angel that decides what rules are, it's the company that decides. And that disconnect, you know, when we have startups come into Seattle Angel Conference looking to get angel investment, but they can't tell me which exemption they're using, then we're sort of, you know, have a fundamental disconnect that we need to fix, right?
Yeah,
and sometimes the lawyers will only tell you Reg D 506B, and sometimes Reg D 506B is not the right answer. For example, I believe in Alaska that Reg D 504 is a much better choice for Alaskan companies than Reg D 506B. And we can have a whole argument about that later. Anyway, that's,
I think often what you will get is very high level information on this stuff. And there is a tendency in the industry to just disregard some of these exemptions because they presumably might require more work. So 504 is a great example. If your investors are concentrated in a single state and you want to have an option to raise from unaccredited and you understand your capital path, then 504 can be completely viable. But most people will advocate against it because people aren't used to using it. And it introduces friction from the people who are going to file the paperwork. So it is very good to get a general overview. 506B, as John said, private placement with known accredited investors. You're not talking about it public. 506C, you know, you can talk about it public. There are some more potential information filing requirements. and all
But
the
no
others.
unaccredited.
Right.
I posted a link in the chat. The SEC, this is the one area where the SEC actually has a somewhat helpful website that lists out the various exemptions that you can file securities under. And so like Pete said, this is all to avoid basically IPOing your tiny little company. Instead, you find an exemption that makes sense for your fundraising path. And there's some new ones. There's innovation in the space. The SEC is slow, but they do continually roll this out. And the vast majority of the reason they do this is to prevent defrauding investors. So honestly, we saw this with the ICO craze. If you don't have regulated fundraising activities, there are a bunch of people out there that will convince people to part with their money, sometimes money that they should not or could not part with. So these exemptions are really there to protect the investors. And they're a pain in the butt for companies to navigate sometimes, but getting familiar with them, one, it's going to make you sound far more professional when you do go and ask for money, and you're not just like, oh, I'm asking for money. But real professional investors are going, in part of their diligence, they're going to want to see that you filed the appropriate exemptions when things start to really pick up momentum.
All right. And then last but not least, we do build product that makes this stuff a whole bunch easier. We cover incorporation formation, IP agreements, stock granting 83B, a whole bunch of the stuff that we've talked about today. So if it sounds like a lot and you don't want to sweat it, come talk to us. We're happy to educate and have conversations and let you know, even if the platform isn't a good fit, what some other options might be. And this is what it looks like. And yeah, you get dedicated support from us. We're happy to have you come join our office hours if you have more questions about this stuff and interact with us and help educate.
Cool. Thank you so very much. I really appreciate you guys doing this. We have time for a couple of questions. Anybody have any questions they want to dive into?
I saw one before that I just wanted to clarify, because Gust has quite a few offerings. A number of you, if you're applied to Seattle Angel Conference, you probably went through our free platform, which is like you build a company profile, you share it with investment organizations or accelerators, you can add people to it. It does have a document repository. It does have structured data about financials and the rounds you're raising. That's all free stuff that's self-reported. The stuff Pete just went through, we have a premium product called Gust Launch, which is basically a SaaS product that all the stuff that we talked about, getting the contract signed, ensuring you have signatures on your stock grant documentations, ensuring that the safe is understood, you have a digital cap table. That's all in our SaaS product, which is basically, we call it a company as a service. It's click next to continue to keep your corporate back office straight in line, be sure everything's signed, be sure that you have a digital representation of your actual agreements, and hopefully save you some time, stress, and hassle on your fundraising journey or your startup journey. All right, we got a hand raised. Oh, go ahead, John.
So when we go through our due diligence, all of these things that you talked about are things that the angels need to sort of check off on their due diligence and make sure that it was done. So presumably with launch, I go check, and it's just all available in my data store, and then I don't have to fight with it.
Pretty much you can download what is effectively the seed to your deal room with a click of a button, and we will give you all the documents you've ever signed, executed, all their attachments, exhibits, whatever you need. There's some stuff that we don't cover yet, like say financial projections or something like that. That's also part of a deal room, and like product screenshots and anything like that. But when it comes to your corporate history, you literally have a perfectly time-ordered list of every agreement and contract you've ever signed. Rather than jumping into Dropbox and searching emails for, oh, this one wasn't signed, use this one, this is the updated draft, etc. We keep things nice and tidy.
Yep. So Dimitri, you had a question.
Yeah, real quick. So I wasn't aware of Gust a few months ago when I went through the whole process with Clerky, which is another popular service for this kind of stuff.
Yep.
So I got all the paperwork set up, including like this initial stock purchase. Are there services or features in Gust that you think are still relevant or applicable, at this stage, or are you guys mostly just for like the earliest parts?
We try to stick with the company for honestly up until, well, we can hang out with you quite a while. We have a fully sophisticated and mature cap table solution underneath Gust Launch. I often describe Gust Launch as a set of guardrails on top of a cap table software, because most founders in the early days don't need the complexity of full cap table software, something like Carta. because things are simple. But if they're put on the rails, they have the documents generated appropriately, they keep their house in order. Once they get to that Series A level, we basically take the guardrails off and be like, hey, you're well along enough that you understand your equity cap table, and now you can manage your own documents. You're doing priced rounds and preferred shares. You're working with counsel to do that. But we differentiate ourselves in the space by basically being a real service that sticks with you and keeps a digital version of your company up to date. We're not just like transactional templates. We are actually digital cap tables, signing solution, month-to-month management where you come in and you check and you constantly, execute new agreements and keep your company up to date. We can onboard people that have incorporated with Clerky. If you've gone way too far, you might be a little outside of our scope, but drop us a line. We can take a look at what you've done so far and see if it's compatible, and we can kind of like get you into the system so that you can start doing new future things in an automated fashion.
Cool, thanks.
Any other thoughts from anyone?
We had a couple of people asking about the materials. John, I'll just forward you the deck and that infographic after this if you can share it out with your network.
Yeah, that'd be great.
Cool with that be?
Yeah, actually, I've got a follow-up page in Notion that we can add it to, and then we can just
excellent.
cover that follow-up page.
Perfect.
Cool. That'd be great. We'll send it to everyone. I think there's a lot of details around this process of running a company that we sort of went through kind of fast. There's an opportunity to dive deeper when you want. So if there's any topics that we went through too quickly, send me a note and we'll put a workshop together around that. We intend to run the Thursday workshops all the way year round. So that'll be good. So I'm not hearing any more questions. Last call, everybody else is saying, yay, did a good job. So good, thank you. We'll call it the day. Thanks so much.